And take a look at the hints from the Chinese stock market. It has been absolutely hammered and, in fact, is sitting at the lowest point since back in 2009. It's been the worst hit of all of the BRIC stock markets, and it's been a leading indicator for the rest of the world. So the question is, do you want to buy it on hopes that the central bank there will ease policy, as Enrique Morales hinted out of Brazil, or do you want to sell it because you want to stay close to home as we're looking at a global slowdown? Let's ask Danny Blanchflower. He's the perfect man to discuss this. He's a former central banker himself, used to be on the Monetary Policy Committee of the Bank of England. He's a Bloomberg contributing editor, Dartmouth University from Hanover, New Hampshire. Danny, good morning. Emerging markets.
Hi, Sarah.
Emerging markets in 2012. How deep is the slowdown?
Well, I think the slowdown is almost inevitable. I think what's happened is people have underestimated the scale and duration of this shock. I mean, we were hit in 2007-8 by a once-in-a-100-year event. And it was always going to eventually come to the emerging markets, especially when the West pulled out all its stimulus. So that's kind of what was coming. I'm very fearful that we will see much more slowing, particularly because we're seeing a big recession in Europe. And what we're seeing is banks are no longer lending. I mean, we've seen today 500 billion of money being taken by the banks and deposited at the ECB. Banks just aren't lending. That's going to hurt the developing world, and it hurts Europe. So I'm pretty bearish on the developing world and on the developed world.
Danny, let's talk about China for a moment, because a lot of people say that there's an impending debt crisis there, that it's going to all blow up at some point. Others say that it's the world's most managed economy and that the authorities won't let it get to that point. Where does the central bank stand, and how does it toe the line here?
Well, obviously, the problem in a way is that I think we really are all in this together. The problem a central bank always has is it has to try and focus and say, is this a bubble? Does it have really information that people in the market don't have? The worry is that it's not absolutely clear what they have, but it's really important, I think, that the central bank keeps an eye on things. And if the economy really starts to slow, then it's going to have to loosen. I mean, this really is going to be the year of the central banks, the Brazilian central bank, the Chinese one, around the world. It's going to be an important year for central banks, not least in China. And the worry I've always had there is, supposing there was a debt crisis coming in China, and if that explodes, just think about the effect on the rest of the world. So China's really important. It's hard to know whether it's going to explode or not, but that really is a big downside risk to the world.
2012 is the year of Danny Blanchflower, because you're a huge fan of monetary easing and quantitative easing. The question is, what kind of ammunition do the developed markets have, the U.S. and Europe? We've already seen them practically max out.
I don't think you're right. I don't think they have maxed out. I don't think that's true. I think what we've seen, actually, is that the central banks have been really crucial, have had a major effect on what's happened. The alternative you should have in your head is 25% unemployment. I don't share the view at all that it hasn't been effective, and they can carry on doing it. In some sense, what I think we've seen is a slowing of the world economies because fiscal authorities tightened and central banks got scared of continuing. They can continue. They have firepower. They can do more QE. The central bank in the UK is going to probably do that, perhaps at its January meeting, most likely in February. They simply have to keep going and keep the stimulus going, because the fiscal authorities are doing exactly the wrong thing by tightening in the depths of a 100-year recession. So the slowing is because stimulus has been withdrawn. Thank goodness for the central banks. QE, here we come again.
Sarah is sitting here shaking her head,
that's how it is.
as you speak. The European Central Bank.
Well, that's what I said last year, and that's kind of what?
No, I said Sarah was shaking her head as you were making your point. You mentioned the Bank of England. You mentioned other central banks. What about the European Central Bank? Because that's what everyone's waiting for, right? Some kind of move from the ECB.
Well, of course.
It's already cut rates twice. How much more scope does it have without actually going to what everyone wants it to do, which is to buy bonds outright?
Well, it has leeway still to cut further. It can buy. I mean, in a sense, the liquidity that it provided the other day has really had an effect and has sort of prevented this cataclysmic collapse. Essentially, it's going to end up going to do more QE. It's sort of doing it now by buying these bonds in the back door, if you like. In some ways, Draghi, he really has actually got it, but I expect you'll see that the ECB has to intervene because of the big problems there are in European funding markets and of banks. $500 billion deposited overnight is not a good sign. The money that they've released, banks are simply not using. So I think the ECB has to cut, has to do QE, has to keep going because the crisis is deepening.
So, Danny, when does this boomerang back to the U.S. and in what form?
Well, I think of this as a sort of major headwind that came from the US to Europe. And the US has been now started to grow reasonably well, much better than any of the European countries. But this crisis in Europe is actually spreading. It's spread from the South European countries to France and to Germany, and certainly to the UK. And the worry is that, if you like, this tsunami, this hurricane, is now sweeping its way back towards the US. And that's the good news. The bad news is if there's major bank failure, the euro starts to break up. That's a really very big downside risk to the US. Two ways, if you like, because of it as being an export market. But the fact is that this is we've seen a global crisis, and all these banks are in it together. So this is a major downside risk, but it's quite the contrast now is really getting quite stark. The consumer confidence numbers in the US have been improving the last few days. We've seen good numbers from the Conference Board, and in Europe the opposite. Flash euro estimates for consumer confidence falling pretty bad there, and really looking like right about now Europe and the UK have probably entered recession already. So I think it really is back to the thing where we talked about before. This is a global crisis. We're all in it together, and it's like the wind has swung a Yui, if you like. It's headed back towards the US.
So what
and part of it, I'll go back to what I was saying earlier.
Right.
It's because the stimulus was withdrawn. And now the economies are exposed because the private sector is not strong enough. They're not spending, they're not investing. So this crisis continues to spread.
So confidence in the U.S. can only remain buoyant as long as the monetary authorities continue to press the gas pedal?
Well, I think obviously the question is, with these shocks coming, what did we do in 2007 and 8? We had concerted action by the fiscal and the monetary authorities working together. Well, essentially, the fiscal authorities are doing nothing. They're trying to cut. They're trying to do the opposite to what they should be doing to stimulate the economy. So that means the pressure rests on the Fed. I mean, Charles Evans has been actually saying that he wanted to see more stimulus, and I'm with him. I'm sympathetic to that view because the shocks are now starting to come. The Bank of England's seen them coming and has had to start to do QE, make statements saying it's got sterling liquidity available if and when there's a crisis coming. So it's really prepare for a shock that's coming. Think of the kind of shocks you're seeing. Is it going to be good news or is it bad news? It's not going to be good news. It can only be bad news. So the US economy is resilient, but it can't be resilient to a European-wide recession and problems through the banking system, which clearly spreads to the US.
Now, you were saying earlier to Sarah that the U.S. monetary policy is not maxed out, that the Federal Reserve does have room. What exactly kind of easing is left then at the Fed's disposal?
Well, it obviously has a number of things that it can do. The scale of the QE could be continued. I mean, they can simply up it and keep going. Clearly, they've said we're going to keep interest rates very low, and a number of policymakers within the Fed have talked about, let's have a set of gateways. Let's say we'll keep interest rates low as long as unemployment remains high. As soon as unemployment comes down, then we'll change it. That gives some credibility. But they literally can go out and do more QE, buy longer-term assets, but also they can go back into the mortgage markets. They can go back and try and kickstart the housing market and buy more securities. So there is still firepower left. I think people have underestimated the scale of the effects of QE before. And remember, a year ago, I was saying you've got to keep on doing this, and people were arguing we should be raising rates. That was wrong then. It's wrong now. We're going to need, probably with these shocks coming, to see more stimulus, not least because we're going to potentially see money flowing from Europe towards the dollar, which will appreciate the dollar, and that will hurt U.S. exports. So that's the process we're likely to see.
Politically, though, it'll be hard to pull off another round of quantitative easing as long as consumer confidence continues to improve and the data shows that the U.S. is weathering this European storm.
Well, that's fine. The question is, has this storm hit it? There are time lags in everything. I mean, if you say, yes, consumer confidence is rising now, unemployment is improving, but a shock that comes from Europe, it hasn't hit yet. It's what happens in 12 months to 18 months down the road. That's what monetary policy makers focus on. They focus on a shock that's coming. So the economy is resilient, but the question is how resilient? And in a way, you should err on the side of caution, err on the side of stimulus, not on the side of a shock hitting the economy and unemployment rising again. So in a sense, the risks are much greater of doing nothing than the risks are of doing too much.
All right. Thank you so much, Danny Blanchflower, pounding the drum for more quantitative easing, a Bloomberg contributing editor and also Dartmouth professor.